Hey, everybody, thanks for joining me today. Recently, there was an article from Barron's that I read that suggested Mondelez stock is undervalued by 10 to 15%. So I thought this would be a really good opportunity to dig into a company, a stock that I really had not looked at much previously. So I'm wondering myself, is this a good time to buy or not? So let's dig into the company. So this stock analysis video on Mondelez International, ticker symbol MDLZ, is made up in four parts. So the first one, we're going to look at the business overview for the company. Secondly, we're going to do a 10-year financial overview on the company. Third, we're going to do a stock valuation using four different valuation methods to determine what the intrinsic value and buy price for the stock could be. And then fourth, was return on investment I would expect to get from the stock at today's price or future prices. So let's dig into the business overview first. So the company is best known for their snacking products that they sell. The four big categories they sell in are chocolate, biscuits, cakes and pastries, and snack bars. An interesting fact about Mondelez International is that its origins are from Kraft Food Incorporated, which was founded in Chicago in 1923. The present enterprise was established in 2012 when Kraft Foods was renamed Mondelez and retained its snack food business, while its grocery business was spun off to a new company called Kraft Food Group. The Mondelez name is actually derived from the Latin word mundus, which is a modification of the word delicious. The Mondelez International Company is a massive large cap business. In fact, their market cap is nearly $100 billion. Though they are a very large company, they did see their core snack categories grow 10% in 2022. And in 2023, their organic net revenue growth was around 14%. So the company has really seen impressive growth in 2022 and in 2023. Here are some of the brand names that you would probably recognize and most people would recognize. So they have the Oreo brand, they have Ritz, Cliff Bars, Cadbury, Chips Ahoy, and many more. They have the number one key snack markets in multiple places across the globe. For example, biscuits, energy, snack bars, number one in the United States. They're number one in Britain with chocolate, number one with biscuits in China. The Mondelez company has grown considerably over the last several years due to 9 different acquisitions that they purchased since 2018, which include Cliff, Grenade, Perfect Snacks, and much more. These key acquisitions have increased their growth, but they've been very strategic in their acquisitions, making sure that they have good return on what they're paying for. In addition, the company is very shareholder minded. They pay a good dividend and they do a lot of share repurchases. From the years 2018 to 2022, the cumulative capital return to shareholders has been $17.4 billion. Mondelez has certainly outpaced its peers by having a 4-year annualized total shareholder return of 16% compared to their peers of 11%. And if you're wondering what their capital allocation was in 2023, they did about $1.5 billion of share repurchases, which is nearly 2% of their total market cap. They also paid out $2.2 billion in dividends during that time. So between share repurchases and dividends, it was almost 4% of their total market cap. And their outlook for 2024 looks very favorable for the company. They believe their revenue organic growth in 2024 looks very favorable from what management's perspective is. They're forecasting organic revenue growth of 3 to 5%. However, they believe free cash flow is going to stabilize, be pretty much flat year over year at $3.5 billion. But they do expect to do more share repurchases in 2024, increasing it from $1.5 billion in 2023 to about $2 billion in 2024. So roughly 60% of what they're estimating for free cash flow will go to share repurchases in 2024. And here in a little bit, we'll go over a 10-year financial history of Mondelez, but I thought this snapshot really gives a good depiction on kind of where the company has been over the last few years. You can see net revenue growth has grown 14% in 2023 and 12% in 2022. You can see adjusted gross profit grew about 18% in 2023, 12% in 2022. You can see similar numbers looking at adjusted operating earnings growth and adjusted earnings per share growth as well. So it's really impressive to see a $100 billion company having mid-teen to high-teen growth year over year over the last couple years. So how have they been able to achieve these impressive growth rates over the last couple of years? And really, they are honing in on their core market, and that is chocolate, biscuits, and baked snacks. So if you can see by this chart here, in 2012, only 59% of their core categories of chocolate, biscuits, and baked snacks made up their total revenue. In 2022, it was 80%, and then going forward, they're trying to get it to 90% overall. They feel that is their best way at achieving growth on the top line and also the bottom line, and so far, it is definitely working. So now let's take a look at a 10-year financial history of Mondelez stock. And I like to look at the big five, which is sales per share, earnings per share, free cash flow per share, book value per share, and also return on invested capital. If you're familiar with Phil Town, this is what he teaches and talks about in his Rule 1 investing book. Also his investing webinars, which I took a few years ago, and I like his approach. And the reason why I like to use on a per share basis is that it factors in share issuances and share buybacks of a company. And we will also be taking a look at different metrics for the balance sheet and the cash flow statement to see how the company has been or where they've been over the last 10 years. So first, let's focus on the big five numbers for Mondelez company. Now, their market cap has grown from $61 billion in 2014 to $98 billion here today. So very, very impressive growth. And if you look, it's been pretty consistent. Yeah, they've had a little ups and downs, for example, from 2018 to 2019, but overall, they've had pretty consistent growth. Now, as far as sales per share goes, they've grown 3% per year over the last 10 years. Earnings per share has grown 11%. Free cash flow has grown 9%. Book value per share has grown 2%. Return on invested capital has averaged 8% over the last 10 years. Just looking at these numbers, what sticks out to me is that the company's been able to grow earnings and free cash flow 3 to 4 times how sales is growing. So they're certainly becoming more efficient in their operational expenses overall. One concerning piece I look at here is their book value per share has only grown 2% per year, but the company has been buying back a lot of shares, which will impact this number. I would have also liked to see return on invested capital being over 10% per year, but being at 8% average is decent. Next, let's take a look at some balance sheet metrics, and I like to really look at debt and also working capital of a company. So when I look at debt, there's two different metrics I like to look at. The first one is long-term debt payoff versus their free cash flow. So how many years will it take for the company to pay off their long-term debt based on their free cash flow? I typically like to see 3 years or less. They've averaged 6 years over the last 10 years. Currently, they're at 4.6. So it's a little higher than I would like to see. However, when I look at debt to equity, I like to see under 100%, which means their equity is higher than their debt. And even better, if we can see it under 75%, that's a good indicator the company is managing their debt pretty well. And we can see here that Mondelez management is handling their debt overall very well. It's at 71% here today and has averaged 70% over the last 10 years. However, their current ratio or their working capital is a little concerning looking at these numbers here. So they've averaged a 0.6. So that tells me that they don't have enough current assets to cover their current liabilities. So the current ratio is essentially current assets divided by current liabilities. Like to see that over a 1, but overall, I mean, it's been pretty consistent over the last 10 years. Look at their 3-year average, 5-year, 7-year, 10-year. It's all been at 0.6, and they've been able to generate enough free cash flow every single year. So this really hasn't been a problem for them. Now, if their free cash flow were to go negative at any point in time, this would be concerning. However, the company has had really robust free cash flow. So far, it hasn't been a problem for them. But it's certainly something to keep in mind if they see sales and earnings fall off in the future. Next up, let's take a look at what the market has been willing to pay for Mondelez stock and also where their margins have trended over the last 10 years. So as far as a market multiple, and I'm looking at a PE basis right now, their average has been a 24 over the last 10 years. Over the last 3 years, it's been at 22. Currently, it's trading around a 20. So that tells me right off the bat, with only having a 3% growth for sales per share, the market has been willing to pay a significant premium for the stock. Yes, their earnings per share has grown 11% per year, which is really good. However, definitely the market has been willing to pay a premium for the stock, paying at a 20 multiple for it. Now, when we look at margins, they've been very, very consistent. They've averaged 39% for gross margins over the last 10 years. Their EBIT or operating margins have been at 15% on average the last 10 years. And even more impressive, over the last 3 years, they've increased their operating margins up to about 16 to 17%. So even though that their gross margins have dipped from 40 down to 38, their operating margins have grown from 16 to almost 17%. And they've just been very consistent overall. So this is a very, very well-run, efficient company. Hence the reason why the market has been willing to pay a higher multiple for a company like Mondelez. So here are all those numbers in one place. So just to summarize real quick, their balance sheet is in really good order right now. They don't have a lot of debt versus their equity, which is fantastic. Their working capital on the surface does look concerning because it is well under a 1 for a current ratio. So they have more current liabilities than current assets. But historically, they've been able to throw off a lot of free cash flow. In fact, if you look at the last 10 years, they've never had a negative free cash flow year, and it's grown very, very consistently at 9% per year, which is very, very impressive. Their operating margins, gross margins have been very consistent. In fact, they've gotten better from an operating margin standpoint over the last few years. I would have liked to have seen the return on invested capital being over 10% on average the last 10 years. And looking at these numbers overall, management is running the company very efficiently at this time and in the past. Certainly one of the most consistent companies I have seen looking back at a 10-year history. So I can definitely see why investors like this stock. And if you add in all the capital allocation they do for shareholders through buybacks and then also dividends, I can definitely see why the market likes this stock. But that doesn't always mean that it's trading at very good value right now. So next, let's go take a look at some valuations and figure out what the fair price of the stock is and maybe some good buy prices for it. So to calculate the intrinsic value of the stock and some good buy prices, I like to look at 4 different valuation models. The first one is a margin of safety calculator, looks at earnings per share over the next 5 years. The second one is a discounted operating earnings model. Essentially, I'm just forecasting operating earnings and then discounting it back to today. The next two are 2 of Phil Town's favorite valuation methods. One is a 10 cap valuation looking at owner's earnings, and the last one is payback time, which looks at free cash flow. So let's go take a look at the margin of safety calculator right now. So the margin of safety calculator looks at earnings per share, and we try to project it out the next 5 years. And based on a rate that we want to get back for the stock, we can determine a good target buy price based on this information. So I think a normalized earning per share for this business is around $3.50 of EPS. I think the growth rate for EPS is going to be around 10% per year over the next 5 years. We saw their growth for EPS was around 11% for the last 10. So I think this is pretty conservative overall. Based on this information, I get a growth multiplier of 1.6, an EPS multiplier of 5.6, which gives me a target buy price of $37 here today, while the stock is trading at $73. So certainly the target buy price is much less. That's not too surprising because of the high market multiple, or the multiple that the market has been willing to pay for this company. So it's not too surprising that it's not looking like a buy according to this model. Next up, let's take a look at my discounted operating earnings model. This one is projecting out operating earnings over the next several years, discounting it back to today to get to a net present value future earnings. And then I come up with an exit multiple that I think the stock will be worth in several years. And then from there, I can get an intrinsic share price of the stock. So in order to get my operating earnings, what I do is I forecast revenue over the next several years. So I think it's going to grow about from $36 billion in 2023 to about $45 billion in 2028. That is a 5% CAGR per year. Now, we already looked at the 10-year history, and it was showing at 3% was the average for sales. So this is a little higher than that, but we can see over the last 3 years, it's trended pretty well. Now, as far as operating margin goes, they're at 16.6% in 2023. I think they're going to be normalized around 17%. So based on that, I get a 5% growth from operating earnings over the next several years. I think a good market exit multiple would be around a 24 for the stock if it can hit those numbers, because we've seen that it can push out some pretty good consistent free cash flow. So based on that, I come with an intrinsic share price of $68 for the stock today. And if you're wondering how to value stocks yourself and come up with intrinsic value, I do offer these valuation templates on my Patreon page, and I go over explaining how to use these different valuation models on how to calculate intrinsic value so you can do the same for stocks that you're researching. And I do think evaluating stocks and figuring out the fair price of a stock is one of the most important ways when evaluating a stock overall. So if you're interested, I'll put a link down in the description. Next up is the first of two Philtown valuations, and the first one is a 10 cap valuation. So essentially what we're trying to do is trying to calculate owner's earnings of the business, divide that by total shares outstanding, and then multiply it by 10. That's how we get that 10 cap, which gives us a good buy price, which we'd be willing to pay for the stock. So there's some built-in margin of safety. Now, to get at owner's earnings, how we get that is first we need to get free cash flow. So I think free cash flow of the business on a good basis or normalized basis would be $3.6 billion. We also need an average tax provision for the company. I'm coming with $1.3 billion for that. So total owner's equity of the business is $4.9 billion. We divide that by 1.3 million shares. I get around a 4 for owner's earnings per share. Multiply that by 10. With rounding, I get a 10 cap valuation of a buy price of $36 here today. The stock price is 73. Very similar to the margin of safety calculator. Not too surprised that it's showing a much lower target buy price because the market multiple is trading at such a premium. The last valuation template we're going to take a look at is the payback time calculator. So what we're trying to do here is calculate free cash flow, project that out the next 10 years. We want to get our money back in 8 years or less. That will indicate that this stock is hopefully selling at a margin of safety. So free cash flow, just like the 10 cap I said, a normalized free cash flow for the business is $3.6 billion. From the research I've done, I think free cash flow can grow 11% per year. So free cash flow 8 years out should be around $8.2 billion. Based on this information, we get our money back in 13 years. So that is much higher than the 8 years we're looking for. So this model does not indicate that it is a buy right now. So now let's take a look at the valuation summaries all in one place. So my discounted operating earnings model suggests the stock should be worth $68 here today. That would be the fair value. A 30% margin of safety would be a $47 buy price. The payback time suggests a buy price of $35. 10 cap suggests a $36 buy price, and the margin of safety calculator suggests $38. So overall, I think the stock is actually trading near fair value right now, maybe a little higher than that. Now, a 30% margin of safety may not make total sense for a company like this that is very consistent. I personally would be able to maybe buy the stock at 15 or 20% margin of safety based on its history and management. But at today's price of $73, it does not look like it's anywhere near that right now. Next up, let's take a look at the return on investment that I would expect to get from today's stock price or a future stock price based on the assumptions that we've already talked about in this video. Let me summarize those assumptions real quick. So first off, I believe revenue is going to grow about 5% per year over the next several years. Operating income is going to grow 5% per year. And then I think a good market exit multiple will be a 24 for this stock. So based on that information, I come up with a 10% return based on a stock price of $68. If the stock were to drop down to $55, I would expect a 15% return on investment per year over the next several years. Now, keep in mind, this does not include the dividend yield that the company is currently paying, which is around 2.2%. So if you were to factor that in on today's stock price at $73, I believe the stock would have a return around 10 to 11% per year over the next several years. But what do you guys think? What do you think the return on Mondelez International will be over the next several years? I would love to hear from you guys in the comment section if you agree with me or not. Thank you to everybody that has stuck all the way to the end of this video. I really appreciate it. Now, if you want to know how to value companies yourself and you want to support the channel, I actually offer a Patreon. You can access my valuation templates there. I explain how to use those valuation templates, how to calculate intrinsic values of stocks, so you can do that yourself moving forward on your analysis looking at different companies. I also share all my stock analysis workbooks for each of the videos I put on YouTube, including this one for Mondelez International. You also get access to my Discord channel and access to my Patreon-only posts. So if you're interested in something like that, I will put a link down in the description below to my Patreon. Thank you everybody for watching this video. I really appreciate it. I'll catch you on the other side. Take care and God bless.